Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Welcome to our video on uranium in unstable markets. In this part, we'll explain why uranium prices move so fast and why many investors choose to stay out in uncertain times. Uranium can look tempting when headlines heat up. A reactor restart here, a supply scare there, and suddenly prices in uranium stocks start moving fast. In an unstable market, that speed can feel like opportunity, but it can also be a trap. In this video, not invested means choosing not to buy uranium-related assets at all, including uranium mining stocks, uranium ETFs, futures, or any product that claims to track the metal. That choice isn't the same as being anti-nuclear. You can believe nuclear power has a future and still decide uranium exposure doesn't fit your plan in. The goal here is simple. Help you decide if staying out is reasonable, and what to watch if you ever want to recheck the case later. What makes uranium so volatile when markets are shaky? Uranium doesn't trade like a big, liquid market. It behaves more like a small pond where one big splash can soak everyone standing nearby. When broader markets are already jumpy, that effect gets stronger. The hard part for regular investors is that many price moves don't come from slow, easy-to-track trends. They come from short bursts of news, positioning, and funding. You can be right about nuclear long-term and still lose money if you buy at the wrong moment, or if the route from story to profits takes longer than expected. A small market, thin trading, and big price jumps. Compared to oil or gold, uranium is a smaller market with less day-to-day liquidity. That matters because price discovery can be messy. A few large buyers, a fund increasing exposure, or a sudden shift in available supply can move prices quickly. Public uranium investments can amplify this. Many uranium miners and developers are small-cap companies. Small caps can swing more than the broad market during risk-off periods, even when nothing changes at the company. Add in wide bid-ask spreads on some names, and you can lose ground just entering and exiting a position. If you're used to broad index funds where price moves feel gradual, uranium-linked assets can feel like a car with a sticky gas pedal. It doesn't always respond smoothly, and braking can be just as rough. Supply shocks, politics, and reactor news can flip the story overnight. Uranium is tied to real-world logistics and politics in a way that can surprise investors. Common catalysts include mine restarts or shutdowns and the market second-guessing if they'll happen on time. Sanctions, trade limits, and shifting rules on nuclear fuel supply chains. Permitting delays, transport issues, and local pushback. Reactor approvals, life extensions, or sudden outages that change near-term fuel plans. Headline risk is constant. The same news can be read in opposite ways. A policy headline might sound bullish for domestic supply, but bearish for a company that relies on imported services. A mine restart can be good for the long-term industry, but bad for near-term pricing if the market fears extra supply. That's the end of Part 1. We've covered the risks, volatility, and key reasons investors stay cautious. Stay tuned for Part 2. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.